Markets can move in ways that make people feel that danger has disappeared, when in reality, danger has only changed form. That is what I want you to understand about this moment. In the last 30 days, the S&P 500 and the Nasdaq have had something very close to a full V-shaped recovery. Bitcoin has also recovered strongly, moving from roughly $66,000 to near $80,000 at the time this story is being told on the surface. That feels like relief. It feels like the market is saying the worst is over. It feels like investors have decided that the conflict between the United States, Iran, and the broader Middle East will not spiral into a global shock. It feels like the ceasefire extension has given markets permission to breathe again. It feels like strong corporate earnings and the continued momentum in artificial intelligence are powerful enough to carry risk assets higher, and maybe they are. But the first mistake in markets is believing that price movement equals resolution. Price movement tells you what people are doing with capital. It does not always tell you that the underlying problem has been solved. That distinction matters. A rally is not the same as safety. A V-shaped recovery is not the same as a clean macro environment. Bitcoin moving higher is not the same as risk disappearing. When people forget that, they become emotional. They turn relief into euphoria. They turn a bounce into certainty. They turn a fragile improvement into a story that everything is fixed. That is usually where mistakes begin. The market rally we are seeing is not an everything is solved rally. It is a relief rally. It is a rally built on the idea that the worst case scenario may not happen immediately. It is a rally supported by earning strength. It is a rally supported by the belief that the AI trade is still intact. It is a rally supported by investors who do not want to be left behind if the next leg up begins without them. But oil prices are still high. The supply risk around the Strait of Hormuz has not disappeared. The ceasefire is not permanent. The Middle East situation has not been fully resolved. There are still reports of drone attacks and military tension. Inflation has not gone away. The Federal Reserve is not fully dovish, and the entire market is still operating inside a system where one headline can change risk appetite very quickly. That means the setup is still fragile. You have to hold two ideas at the same time. The first idea is that markets can continue higher even when the world is unstable. The second idea is that markets can drop quickly when the unstable parts of the world become visible. Again, both are true. This is why investing requires systems, not emotions. The investor who says, the rally proves everything is fine, may become reckless. The investor who says, the risks are still there, so I should do nothing, may miss one of the most important wealth-building windows of the decade. The better approach is to understand the forces, size your positions, keep cash reserves, and gradually build exposure to the assets and companies that have the greatest asymmetric upside if the long-term trend continues. This is not about predicting one perfect entry point. It is about positioning yourself intelligently in a world where the biggest changes are happening faster than most people can process. Markets are not rational in the short term because people are not rational in the short term. Markets are made of people, institutions, algorithms, funds, traders, pension managers, retail investors, governments, and central banks. They all have different time horizons, different incentives, different information, and different constraints. When fear dominates, they sell. When greed returns, they buy. When a worst-case scenario does not happen, they often rush back into risk assets before the deeper problem is fully solved. That is human nature. You can call it irrational, but you must still respect it because that is the market you actually invest in. Right now, markets are behaving as if the immediate geopolitical fear has been reduced. The US-Iran situation looks less dangerous than it did when the worst case scenario was still on the table. Investors are assuming that a full ground war or a complete disruption of the Strait of Hormuz is less likely than before. That is a valid reason for risk assets to rise. But it is not a guarantee. A fragile truce can break. Oil can spike again. Inflation can reaccelerate. The Fed can delay rate cuts. Corporate margins can come under pressure. Bitcoin can reverse quickly if liquidity tightens. So the question is not whether markets are right or wrong today. The question is how you should act when the long-term opportunity is real, but the short-term risk is still elevated. The answer is not to be all in. The answer is not to be all out. The answer is to use a disciplined accumulation system. That means dollar cost averaging into the assets and themes you believe have durable long-term upside while keeping enough cash to buy more if a larger dip arrives. This is a very important principle. Waiting for the perfect crash can be a mistake. The market does not owe you a perfect 20% correction. It does not owe you a clean entry. It does not owe you emotional comfort. If you sit entirely on the sidelines waiting for the exact bottom, you may never get it. And in a world where the largest technological shifts in modern history are underway, being absent can be its own risk. Historically, markets spend more time in bull conditions than bear conditions. The S&P 500 has finished positive in a majority of years. That does not mean every year is safe. It means the long-term bias of productive assets has been upward, driven by earnings, innovation, reinvestment, productivity, and liquidity. If you are in the wealth accumulation phase, you cannot eliminate upside exposure because you are afraid of every headline. That is the mistake many people make. They wait for certainty, but certainty is expensive. When certainty arrives, prices have often already moved. The better move is to buy systematically and keep extra firepower. If prices go up, you participate. If prices go down, you buy more. If the market chops sideways, you accumulate patiently. If a real panic comes, you have cash. This is not exciting, it is effective. Now, why is this moment so important? Because the world is entering a phase where artificial intelligence, robotics, automation, crypto infrastructure, digital markets, and new forms of productivity may create one of the largest wealth transfers of our lifetime. And most people are not prepared for it. They are watching the rally like it is only about stock charts and Bitcoin candles. It is much bigger than that. The real story is that the structure of work, income, ownership, and productivity may change. Some of the most powerful entrepreneurs in the world are now openly talking about the possibility that AI will eliminate or dramatically reduce the need for many traditional jobs. Elon Musk has discussed government-issued checks or universal high income as a way to deal with AI-driven unemployment. Sam Altman has discussed related ideas around universal basic wealth. The UK has also been reported as considering policy responses for workers displaced by AI. Whether these exact ideas happen soon or much later is not the point. The point is that the people closest to the technology are talking about a future where productivity is created by machines and the income distribution system must be rethought. That is a major signal. When the people building the machines begin discussing how to support humans displaced by those machines, you should pay attention. The future may not arrive in 5 years. It may take 15 years. It may take longer. But the correct question is not whether the timing is perfectly knowable. The correct question is whether you should prepare for a world where owning the machines, the networks, the protocols, the platforms, the infrastructure, and the scarce assets matters much more than simply selling your labor. That is the divide. There will be people who own the productive systems, and there will be people who consume inside systems owned by others. That is the generational wealth divide. One path is to do nothing. You become a consumer in someone else's economy. You live on wages that may be disrupted by automation. You depend on government transfers if your work becomes less valuable. You rent from the owners. You buy from the owners, you use the platforms built by the owners, you become a user, not an owner. The other path is to prepare. You study the trends, you invest in the companies and assets that may benefit from the transition. You diversify beyond one country, one currency, one job, one asset class. You build exposure to productive assets, Bitcoin, gold, growth companies, international assets, and emerging crypto infrastructure where appropriate. You create a financial life that can survive the transition and potentially benefit from it. This is not about worshiping money. Money does not solve every problem. It does not give meaning by itself. It does not create true peace. But financial stability affects where your children go to school, the neighborhood you live in, the risks you can take, the medical choices you have, the amount of stress your family carries, and whether a large problem becomes manageable or devastating. In a period of technological disruption, financial preparation matters even more, because the people who prepare before the shift have choices. The people who wait until the shift is obvious often have fewer choices. That is one of the repeated patterns in history. The opportunity is most uncomfortable before it is obvious. When COVID first appeared, many people dismissed it as distant. They thought it would not affect them. Then, very quickly, the world shut down, markets collapsed, supply chains broke, and ordinary life changed. The same kind of disbelief exists around AI today. Some people say it is a bubble. Some say AI will not affect their jobs. Some believe it will affect jobs but still do nothing. That last group is the most dangerous group to be in. Knowing and not acting is often worse than not knowing. If you see the possibility of a major shift and still refuse to prepare, the problem is not lack of information, it is lack of behavior. And in markets, behavior determines outcome. There will be winners and losers in this transition. That may sound harsh, but systems do not distribute rewards equally. The people who own assets tied to the productive transition may benefit. The people who only sell labor into a changing market may be under pressure. The people who diversify and prepare may have options. The people who ignore it may become dependent. You cannot hate the game into changing. You have to understand the game and position yourself wisely. Now, the challenge today is not lack of information. It is too much information. In the past, retail investors were at an information disadvantage. Wall Street had the terminals, the research, the networks, the analysts, the flow, and the speed. Ordinary people were usually late. Now, AI tools, social media, public filings, on-chain data, newsletters, investor communities, and real-time markets have given ordinary investors more access than ever before, but access alone does not create wisdom. Too much information can create paralysis. It is like trying to drink from a fire hose. Most people are not failing because they cannot find data. They are failing because they do not know which data matters. That is why focus is a competitive advantage in this environment. The investor must focus on the variables that actually move the market right now. I would focus on 5 things, not as a list to memorize, as a framework for filtering noise. The first is the war and geopolitical tension around Iran. The market is reacting to whether this situation escalates into something much larger. If the United States becomes drawn into a deeper conflict, if the Strait of Hormuz is disrupted, or if Iranian military actions increase, the market will reprice risk. The United States wants to prevent Iran from keeping highly enriched uranium and further expanding enrichment. It wants to reduce Iran's missile capabilities. It wants to keep the Strait of Hormuz open for oil tankers and free traffic. Iran wants the war to end on terms that lift sanctions, compensate damage, protect its authority, and preserve key parts of its strategic position. It wants control and influence over the Strait of Hormuz. It wants to continue its enrichment program. It wants its combat forces reduced in the region. Those goals are not aligned. That is why a clean resolution is hard. The most likely path may be a messy middle tensions flare. Negotiations drag on, the blockade or pressure remains, isolated incidents occur. Both sides test boundaries without necessarily choosing full-scale war. Markets can handle a messy middle better than a full escalation, but a messy middle still creates volatility. The second variable is oil. Oil is the fastest transmission mechanism from war into the economy. When oil rises, inflation pressure rises. When inflation pressure rises, the Fed has less room to cut rates. When the Fed has less room to cut, liquidity remains tighter. When liquidity is tight, risk assets face pressure. Oil affects transportation, shipping, plastics, fertilizer, food, aviation, consumer spending, and corporate margins. A spike in oil can move through the entire system for a broad risk. On bull run, oil needs to cool or at least stabilize. If oil stays elevated or moves higher, inflation becomes harder to control and liquidity can get sucked out of risk assets. That is why oil matters even if you do not invest in energy. The third variable is inflation and rate cuts. Markets want lower interest rates because lower rates reduce borrowing costs, support housing, support businesses, increase valuation multiples, and encourage risk-taking. With Jerome Powell eventually being replaced in the source narrative by Kevin Warsh, markets may begin pricing a different policy path even before a rate cut happens. Markets can move if the probability of future cuts increases. Markets are forward-looking, they do not wait for the cut itself. They move when expectations change. But if inflation reaccelerates because of oil or other cost pressures, rate cuts become harder. That is why inflation remains one of the central risk variables. The fourth variable is corporate earnings. Earnings are the real engine behind stock prices over time. Liquidity matters, sentiment matters, but if companies continue to grow profits, the market has fundamental support. The source points to earnings expectations rising. If companies keep producing strong profits and analysts revise expectations higher, the market can continue grinding higher even in a noisy macro environment. This is one reason the rally has been resilient. Strong earnings create support. The fifth variable is AI optimism. Right now, markets still trade heavily on whether investors believe the AI story remains intact. The last major AI-related scare came when a low-cost, high-performance Chinese model created fear that US AI leadership and chip spending could be less secure than believed. That fear caused a huge sell-off in NVIDIA and related names. This shows how sensitive the market is to the AI narrative. If investors believe AI demand, infrastructure spending, model progress, and productivity gains remain strong, the market can keep rewarding large-cap technology and related assets. If that confidence breaks, the downside can be violent. So you watch the AI narrative carefully. War, oil, inflation and rates, earnings, AI optimism. Those are the real needle movers. Everything else must be filtered through whether it changes one of those variables. If a headline does not change one of these drivers, it may be noise. Most investors lose money because they react to noise as if it were signal. Now, what is the practical stance? Markets can still pull back. The bottom may not be fully in, there may be more volatility, but over a 2-year, 5-year, and 10-year horizon, the broad direction of productive assets may still be higher, especially if AI and technological progress continue reshaping the economy. If you agree with that high-level thesis, then the rational move is to have positions in the market now. Not to be completely sidelined waiting for perfection. If prices fall, you buy more. If prices rise, you continue buying. You allow yourself to participate in the high time frame direction while managing short-term risk. That is the essence of disciplined accumulation. Now the next question is where the asymmetric upside may be. This is where things become more difficult. The biggest opportunities do not usually come from obvious assets after everyone understands them. They come from the confluence of narrative, liquidity, attention, timing, relative strength, and upside that has not yet been fully priced in. A strong asymmetric setup usually has several characteristics. A large narrative that can attract attention, a real catalyst or development that can bring liquidity. A market structure where upside is much larger than downside, if the thesis plays out a moment when the broader public has not fully recognized it. Relative strength during uncertainty and a clear path for capital to rotate into it when conditions improve. This is how major crypto winners often work. In a previous cycle, the source describes finding Aerodrome before the crowd fully understood the base chain narrative. The key was not simply that a token existed. The key was that Coinbase had a large strategic plan. Base had a network narrative. Aerodrome had exposure to that ecosystem. The token was listed in a way that gave accessibility, and the market had not priced it correctly yet. That is the structure of an asymmetric idea. Narrative, infrastructure, liquidity, access, underpricing, timing. When those factors align, upside can be enormous, but the same kind of setup is hard to find. It requires research, conviction, and the willingness to buy when the market still feels uncertain. It also requires the willingness to be wrong. In the Aerodrome example, the price went down after the initial purchase. Coinbase had an app issue. The market moved against the position. It would have been easy to panic, but conviction based on research allowed the position to be increased. That is how big wins often happen. But be careful. Conviction is not stubbornness. Conviction comes from research, structure, and a thesis that survives price movement. Stubbornness is refusing to change when the facts change. You need the first, you must avoid the second. Right now, the framework is to look for areas where attention will return fastest when markets stabilize and begin trending higher. That means identifying sectors, assets, and narratives that performed well before the sell-off, held up better than expected during uncertainty, and have real developments that are not fully priced in. Relative strength matters. If something refuses to die during fear, pay attention. That does not mean you buy it blindly. It means you add it to the watch list, you study it, you examine the catalyst, you compare upside and risk. You see whether narrative, momentum, liquidity, and fundamentals are aligning. When markets come back, money does not flow evenly into everything. It rotates. One sector moves first, then another, then another. The investor who has prepared a watch list before the rotation has an advantage. The investor who only notices after the candle is up 80% is late. This is why research during choppy markets matters. A lot of people only pay attention when markets are fun. They disappear when prices are uncertain. That is backwards. You should prepare when the crowd is asleep and become more cautious when the crowd is euphoric. Do the opposite of the crowd, but do it with a system. Crowd behavior can be a signal, not a complete strategy. When retail attention is low, when views are down, when people stop caring, when social media is quiet, that can suggest apathy. Apathy can be a better environment for accumulation than euphoria. But apathy alone is not enough. You need the other factors: narrative, liquidity, relative strength, catalysts, upside, risk control. The confluence is what matters. Now, what are the specific areas to watch in the source framework? The first is Bitcoin. Bitcoin is the core crypto asset. The source's view is that the thesis remains intact above $70,000, that the $60,000 to $70,000 range is attractive, and that a move toward $50,000 would be a much stronger buying opportunity for someone with experience and a mechanical system. The important point is not the exact price level. The important point is having levels before the market reaches them. That is how you avoid. If you know in advance where you are willing to buy, what invalidates your thesis, and how much capital you will deploy, then you do not have to improvise under stress. Improvising under stress is where many people fail. Bitcoin also plays a different role depending on the investor. For some, it is core long-term exposure. For others, it is a liquidity rotation asset. For others, it is a hedge against monetary debasement. For others, it is a speculative risk asset. You must know why you own it. If you do not know the role, you will not know what to do during volatility. Bitcoin can fall 30% or more quickly. That is normal for the asset. If that would cause you to sell emotionally, the position is too large. The second asset in the source framework is hyperliquid through the HYPE token. This is presented as one of the highest conviction crypto infrastructure plays. The thesis is based on real usage, fees, liquidity, revenue, buybacks, and the expansion of on-chain financial markets beyond crypto. Hyperliquid is described as generating very large annualized fees and earnings, with billions in total value locked in enormous monthly perpetual volume. The important point is that this is not only a meme narrative. It is a platform with measurable activity in crypto. On-chain data can be powerful because you can see flows, volume, revenue mechanisms, and value accrual in real time. The source emphasizes that a very high percentage of revenue is routed back into HYPE buybacks, creating an aggressive value accrual mechanism. That matters because token economics often fail when there is no connection between platform usage and token value. If usage creates revenue and revenue supports buybacks, the structure becomes more interesting. But there is risk. Hyperliquid has a decentralization concern because the network currently runs with a small validator set. That matters if you care about credible neutrality over time. Centralization can create regulatory, technical, governance, and trust risks. So the thesis has both strength and weakness. The strength is usage, liquidity, revenue, expansion, and token value accrual. The weakness is decentralization and the risk that execution, regulation, competition, or market conditions change. A serious investor holds both sides. Hyperliquid's broader narrative is also important. It is not only a crypto exchange, it is moving toward becoming a blockchain that can host broader financial markets, including commodities, equities, futures, like exposure and prediction markets. If that plays out, the opportunity can be larger than a normal crypto trading venue. The source describes oil, gold, silver, S&P 500 futures, NASDAQ indexes, and major equities being traded on the platform. That suggests a convergence between crypto infrastructure and traditional markets. That is a powerful narrative. If finance moves on-chain, the platforms that capture liquidity can become extremely valuable. The next catalyst mentioned is HIP-4, a permissionless prediction market native to Hyperliquid. Prediction markets have grown significantly, with platforms like Polymarket and Kalshi pushing into mainstream awareness. If Hyperliquid can capture a meaningful share of that activity while integrating margin and existing perpetual positions, the fee base may expand further. That is the thesis. But again, the thesis is not certainty. It depends on execution, adoption, user experience, regulation, liquidity, and competition. Now, for investors seeking a more leveraged or equity market version of Hyperliquid exposure, the source discusses Hyperliquid Strategies Incorporated trading on NASDAQ. This is not a crypto token. It is a public equity vehicle connected to Hype Treasury exposure. It reportedly holds a large number of Hype tokens, has remaining deployable capital, an equity line of credit for accumulation, and a share repurchase program. It is framed as structurally different from earlier digital asset treasury companies because it has unrealized gains and exposure to a token that may generate operating income through staking or yield mechanisms. The important investment principle here is that treasury companies can trade at premiums or discounts to net asset value. If a vehicle holds crypto assets, the public equity market may price that exposure differently from the underlying tokens. Sometimes it trades at a premium, sometimes at a discount. Sometimes the premium expands during bull markets and collapses during bear markets. That creates opportunity and risk. If per trades around net asset value, there may not be an obvious discount. But if risk on conditions return and the market begins rewarding treasury vehicles again, the equity could move aggressively. This is a more complex structure than simply owning the underlying token. It has equity market risk, management risk, financing risk, premium to NAV risk, liquidity risk, and potential dilution risk. So it belongs in the watch list category for people who understand the mechanism. The next major asset is MicroStrategy. The thesis is simpler. MicroStrategy is essentially a regulated equity wrapper around a very large Bitcoin treasury. It gives stock market investors leveraged exposure to Bitcoin through a public company vehicle. Michael Saylor continues to accumulate Bitcoin aggressively, and the company has publicly targeted even larger holdings. If Bitcoin rises strongly, MicroStrategy can move more than Bitcoin. That is the appeal. But leverage cuts both ways. MicroStrategy has risks. It can trade at a premium or discount to the value of its Bitcoin. It has financing risk. It has volatility risk. It is dependent on Bitcoin's direction and market enthusiasm for the treasury strategy. If Bitcoin falls hard, the equity can fall harder. So the clean thesis is this. If you are bullish on Bitcoin and want public equity exposure with more torque, MicroStrategy may be a vehicle. But if you cannot handle volatility, it can be dangerous. A vehicle that magnifies upside can also magnify stress. The next speculative category is the meme coin allocation, represented in the source by Pengu. This is the highest risk kind of exposure. The thesis is not cash flow. It is brand narrative, liquidity, community, product market fit, retail onboarding, and the possibility that one high-cap meme coin captures broad attention during a bull run. Every crypto cycle tends to produce meme coin winners, Dogecoin, Shiba Inu, Dogwafat. The source argues that Pengu could be one of the vehicles that captures the next wave. This may be true. It may also be completely wrong. Meme coins are extremely volatile and can be diluted by endless new token creation, changing attention, pump, and dump behavior and narrative exhaustion. So the role must be clear. This is not core wealth preservation. This is a speculative watch list or small allocation for someone who understands the risk. A meme coin can produce explosive upside. It can also go down dramatically or fail to regain attention. Position sizing is everything. You do not put serious life capital into an asset whose value depends largely on attention unless you are prepared to lose it. The next equity-like crypto vehicle is BMNR, or the Ethereum-related treasury idea described through Tom Lee and a public market structure. The source's thesis is that Ethereum remains relevant, that certain treasury companies may benefit when risk on conditions return, and that narrative-driven public figures can help market these vehicles to traditional investors. This is the same pattern as other digital asset treasury plays. The asset exposure matters, the management team matters, the premium or discount to NAV matters, the ability to raise and deploy capital matters. The narrative matters, market conditions matter. When liquidity returns, these vehicles can move quickly. When liquidity disappears, they can collapse or stagnate. So again, this is not passive investing, it is cycle-aware exposure. Now, putting the entire crypto and equity watch list together, the Source S plan is to hold some core Bitcoin exposure, use MicroStrategy of seeking leveraged public market Bitcoin exposure, continue watching Ethereum and Solana. Related opportunities, build conviction around hype as a primary altcoin, consider Pengu as a meme coin watch list or speculative exposure, and watch PER as a structural TradFi linked hype treasury play. The deeper lesson is not that every one of these will work. The deeper lesson is how to build a watch list around asymmetric opportunities, core asset leveraged wrapper, high conviction, alt infrastructure, speculative attention asset, treasury equity vehicle. Each has a different role. Do not confuse them. Bitcoin is not a meme coin. MicroStrategy is not Bitcoin. Hype is not a simple meme narrative. PER is not hype. Pengu is not infrastructure. BMNR is not Ethereum itself. Each asset has a different mechanism, risk, liquidity profile, and reason for existing. A portfolio becomes dangerous when the investor treats all risky assets as the same. They are not the same. Now, one of the most important lessons from the source is that the biggest wins do not usually come from overtrading. They come from waiting for the right conditions. The source uses the analogy of fishing. Sometimes conditions are perfect, the tide is right, the fish are active, you can cast almost anywhere and get bites. Other times the water is pressured, the fish are not active, and you can work very hard for very little. Trading and investing in speculative assets can be similar. There are periods when the high time frame and low time frame trends align, liquidity is flowing, risk appetite is rising, narratives are clear, retail attention is returning, breakouts are working. In those moments, aggressive positioning can work, but most of the year may be chop. In chop, overtrading destroys people. They take small losses repeatedly. They chase every green candle. They jump between narratives. They burn mental capital and actual capital. That is why knowing when not to trade is as important as knowing what to buy. There is a season for research, a season for accumulation, a season for aggressive deployment, a season for taking profits, and a season for doing nothing. Most people want to be active all the time. Markets punish that. Patience is not inactivity when it is part of a system. Patience is preparation. Now, selling is often harder than buying. This is especially true in crypto. People focus on entry because entry feels exciting, but exits determine whether paper gains become real wealth. A token can go up 10 times and then fall 80%. If you do not sell any, the market can take back what it gave you. In fast-moving speculative markets, profit taking discipline is essential. You must have rules before euphoria arrives. At what multiple do you take some off? What position size is too large? What happens if a token becomes 40% of your portfolio? What invalidates the thesis? What is your time horizon? What tax consequences apply? What capital must be moved into safer assets? These questions must be answered before the crowd returns. If you wait until euphoria, you will probably make emotional decisions. Euphoria tells you the move will never stop. Fear tells you the opportunity is over. Both lie. A system helps you act despite them. Now, there is also a personal and psychological dimension in the source. It speaks about being grounded, about faith, about staying steady during turbulent markets. I will translate that into a broader principle. Every investor needs something stronger than market emotion. For some people, that is faith. For some, it is family. For some, it is principles. For some, it is a written plan. For some, it is a long-term mission. Whatever it is, you need an anchor, because markets will test you. When positions fall, stress rises. When assets move up quickly, greed rises. When other people seem to be getting rich faster, envy rises. When you miss a trade, regret rises. When you buy and the price falls, doubt rises. If you are not grounded, you will react. Reactive investors are usually late. They buy when they should be cautious and sell when they should be patient. Being grounded does not mean being passive. It means your decisions come from principles, not emotional noise. That is one of the great advantages in markets. Clarity under pressure. Now let us bring this back to the main theme. This may be one of the last major windows for building generational wealth before the AI transition becomes obvious to everyone. That statement should not be interpreted as a guarantee or a reason to gamble recklessly. It should be interpreted as a call to take preparation seriously. The world is changing quickly. AI is accelerating, robotics is coming, crypto infrastructure is developing, digital markets are maturing, traditional finance is moving closer to on-chain systems. Large technology companies are spending extraordinary amounts on AI infrastructure. Retail attention is still not fully euphoric. Markets have recovered, but macro risks remain. That combination can create opportunity, but opportunity is not evenly distributed. It goes to those who prepare. Preparation means you do your research before the crowd returns. You build a watch list. You identify the 5 macro needle movers. You understand your core positions. You keep cash reserves. You dollar cost average. You define buy levels. You size speculative positions modestly. You know when to sell. You avoid overtrading and chop. You focus on narratives with real liquidity, adoption, and catalysts. You do not confuse excitement with evidence. You do not confuse conviction with denial. You do not confuse volatility with invalidation. You do not confuse a rally with safety, that is the discipline. Now there is a final practical issue. Most people want to be told exactly what to buy. That is a dangerous desire. If someone gives you a ticker and you do not understand the thesis, you will not hold it properly. If it falls, you will panic. If it rises, you will not know when to take profits. If the thesis changes, you will not notice. Borrowed conviction breaks under pressure. You must build your own conviction. That does not mean ignoring other people's research. Good research can save time and reveal opportunities, but it cannot replace your own understanding. If you own Bitcoin, know why. If you own hype, know why. If you own perp, know how the treasury structure works. If you own MicroStrategy, know the leverage and premium risk. If you own Pengu, know that it is attention, driven and speculative. If you own BMNR or another treasury equity, know the NAV holdings, capital structure, and cycle risk. If you own AI stocks, know the earnings, valuation, and narrative risk. If you own cash, know the opportunity cost. Every asset must have a reason. Now, how do you prevent information overload? You simplify the dashboard. You watch the 5 macro drivers. You maintain your watch list. You track relative strength. You track catalysts. You track price levels. You track liquidity. You track whether retail attention is returning. You track whether the thesis is strengthening or weakening. Everything else is noise until it changes one of those variables. This is how you reduce chaos. The world will not become less noisy. You must become more selective. Now, the rally in stocks and Bitcoin has already happened in part, so you must avoid emotional chasing. If you have no exposure, begin slowly. DCA. Do not try to make up for lost time in one purchase. Keep cash for pullbacks. Build positions around levels. Accept that you may not catch the exact bottom. If you already have exposure, review your allocation. Do not let one volatile asset dominate your financial life unless you knowingly accept that risk. Take profits when the position becomes too large. Rebalance into safer assets if necessary. If the market dips, do not panic automatically. Ask whether the 5 drivers changed. Did war risk worsen? Did oil spike? Did inflation reaccelerate? Did rate cut expectations collapse? Did earnings break? Did AI optimism weaken? If the answer is yes, reassess. If the answer is no, the dip may be noise or an opportunity. This is the benefit of having a framework. You do not react to price alone. You react to price plus thesis. Now, in a generational wealth window, the hardest thing is to avoid both fear and greed. Fear keeps you out when you should be accumulating. Greed pushes you too far in when you should be managing risk. The middle path is discipline. Accumulate systematically. Keep optional cash. Take concentrated risk only when the confluence is strong. Size according to risk. Take profits into strength. Stay grounded. Do not let the market turn you into a gambler. This is where I disagree with the purely emotional language around getting rich quickly. Big upside is real, but it must be handled with seriousness. The objective is not to feel excitement. The objective is to build capital that survives. The people who become wealthy and keep it are not only good at identifying opportunities, they are good at surviving the cycle after the opportunity. They understand when to press and when to wait. They understand that 80% of the year can be chop and 20% can create most of the returns. They understand that the moment to prepare is when nobody cares. They understand that selling is often harder than buying. They understand that one big win can change a life, but one uncontrolled mistake can give it back. That is the real game. Now let us summarize the structure clearly. Markets have recovered because worst case geopolitical fears have eased, earnings remain strong, and AI optimism is still powerful. But the recovery is fragile because oil remains high. The ceasefire is not permanent. Inflation is unresolved. The Fed is not fully supportive. And geopolitical risk can return quickly. The correct broad strategy is not to wait entirely on the sidelines and not to go all in emotionally. The correct broad strategy is to dollar cost average into high conviction asymmetric opportunities while keeping cash reserves for larger dips. The AI transition may create a major wealth divide between owners and consumers, between people who prepare and people who depend only on wages or future government support. The 5 macro variables to watch are war risk, oil prices, inflation and rate cuts, corporate earnings, and AI optimism. The asymmetric opportunity framework is narrative plus liquidity plus relative strength plus upside plus catalysts plus underpricing. The watch list areas include Bitcoin, Hyperliquid, and Hyper MicroStrategy, Pengu, Ethereum, related treasury exposure, and other assets that fit the same structure. But every one of those carries risk and none should be owned blindly. The real edge is preparation, not prediction. Research when the crowd is asleep, build conviction before the move. Deploy when the confluence strengthens, avoid overtrading during chop. Take profits when euphoria returns. Stay grounded so volatility does not control you. That is how to play a generational wealth opportunity without becoming reckless. The opportunity is real, the risk is real, both truths must be held together. If you only see opportunity, you may blow yourself up. If you only see risk, you may miss the trade of a lifetime. The skill is to build a system that lets you participate in the upside while surviving the downside. That is what serious investors do. They do not wait for the world to become certain. They prepare while it is uncertain. And when the moment comes, they act from a plan, not from panic.